Welcome to the Deep Dive, where we get into the nitty-gritty of recent corporate reports. Today, we're looking at Willis Lease Finance Corporation, WLFC. They're big in aviation leasing, especially engines and related services.
That's right. And our mission today is really to figure out a bit of a puzzle. WLFC had, honestly, a fantastic operational quarter. Record numbers, beat expectations.
Okay.
But the market reaction, the stock just tanked on the day. Sold off hard.
Yeah.
So we need to dig into why. What did the market see in let's say, the quality of those earnings that made them ignore the headlines?
Yeah, that disconnect is always fascinating. Okay, let's lay out the top line stuff first. This was reported pre-market November 4th, and you said they beat estimates.
Crushed them, really.
Yeah.
Revenue hit $183.4 million.
Wow.
Yeah, that's a huge 25.4% jump year over year and way ahead of what analysts expected. And then earnings per share, diluted EPS came in at $3.25.
And the consensus was?
Consensus was lower, around $2.86 according to FactSet. So a solid beat there too. And they didn't stop there. They also hiked the dividend.
Oh, really? By how much?
Pretty substantially, up to $1.40 per share from 25 previously. That usually signals confidence, right?
Absolutely. A double beat and a big dividend raise. That sounds like a recipe for a stock rally, but that's not what happened.
Not at all. And that's the head scratcher. The shares just kept falling all day long, closed down almost 6% and on pretty heavy volume too.
So the market looked past the great top line and saw something worrying underneath. Smoke in the details, maybe?
Exactly. They saw fire in the fine print, as you said. We've got to pinpoint what spooked them. But first, let's acknowledge the good stuff. Because the core engine leasing business, it's firing on all cylinders.
Okay, the leasing flywheel, as they call it.
Yeah, it's spinning fast, driven by, real shortages out there in the aviation market.
We know demand's been crazy high, especially post-pandemic travel recovery and all that. Did it show up in their actual numbers, like rents and usage?
It really did. Core lease rent, just the money from renting engines, hit a record $76.6 million. That's up nearly 18% from last year.
Okay, solid growth there.
But here's a really interesting one. Maintenance reserve revenue. That also hit a record. $76.1 million.
Whoa, wait. That was up how much?
Up a massive 52.8% year over year.
52%. Okay, for listeners, remind us why that maintenance reserve number is so important and why such a huge jump matters.
It's crucial. Maintenance reserve revenue is basically cash collected up front from the airlines leasing the engines. It's meant to cover future engine maintenance costs down the road.
So
The fact that it's growing so fast tells you a couple of things. One, WLFC has pricing power because engines are scarce. They can demand better terms. And two, it means they're pulling cash flow forward, collecting it now, which is great for their own finances and de-risks future spending. It's a very healthy sign for cash flow quality.
Got it. So better terms, more cash up front. And are the engines actually being used more? What about utilization?
Yep, that ticked up too. Average portfolio utilization was 86.0%.
Which is up from...
Up from 82.9% in the same quarter last year. So more engines out there working. And they're also selling some older gear pretty profitably. Reported a $16.1 million gain on selling leased equipment.
Any color on those margins?
Yeah, management pointed out it implies almost a 22% margin on those sales. They see that as kind of proof that the real value of their assets isn't fully reflected on their books.
Right, the classic unrecognized value argument for lessors. And management tied this strong performance back to the broader industry issues, I assume.
Oh, absolutely. They talked a lot about high costs for new engines, and especially the huge MRO bottlenecks, maintenance, repair, and overhaul. The shops are just jammed.
Yeah, we hear that everywhere.
And that gridlock drives airlines straight to lessors like WLFC, particularly for their integrated service packages. Things like their constant thrust program, which helps airlines avoid those super expensive, time-consuming shop visits if they can.
Makes sense. If you can't get your engine fixed quickly, leasing a replacement and using smart maintenance strategies becomes essential. Okay, so operationally, a great story. Utilization up, rents up, cash flow looking strong from those reserves.
Exactly.
But clearly, that's not the whole picture the market saw. So let's pivot. Where did the costs start to look ugly? What were the red flags?
Okay, yeah. This is where the skepticism crept in. And it starts really with G&A general and administrative expenses.
How bad was the jump?
It surged. Came in at $49.2 million, which is up $9.2 million from the year before. Management, they tried to explain it.
How did they explain nearly $10 million extra in overhead?
Well, a chunk of it, $3.5 million, was apparently from higher consultant fees. Yeah. And they linked that partly to their work on sustainable aviation fuel. Ask.
Wait, hold on. $3.5 million just on staff consultant fees in one quarter. Is that like a one-time investment, or is this a sign they're having to spend a lot just to keep up with future tech demands and it's hitting profits now?
That's precisely the debate. Is it strategic investment or just cost friction? The price you pay to stay relevant with airlines who are all focused on emissions now.
Feels like friction. What else was in that G&A increase?
The other main piece was personnel costs, up about $2.8 million. That included incentive pay bumps and also non-cash share-based compensation.
Ah, the dreaded share-based comp. Did they say anything about that specifically? Sometimes it can be lumpy.
They did clarify it. They said it looks high partly because of how they historically granted equity awards. Apparently, this sort of elevated level is going to stick around for a few more years before it runs off the P&L.
Okay, so that's not really temporary then. It's a non-cash hit, sure, but it's going to drag on reported earnings quality for a while. The market probably didn't love hearing that.
No, definitely not.
Yeah.
It reads as a recurring headwind.
Okay.
Moving beyond G&A, there was another significant item, write-downs.
Asset write-downs, how much?
$10.2 million in equipment write-downs. They said this was impairment on 8 engines, and 6 of those are now being moved to held for sale.
8 engines. Management's spin on this, I'm guessing, was positive, like cleaning house.
Kind of. They framed it as being proactive, getting rid of older, maybe unserviceable engines to monetize them, rather than sinking huge money into a full shop visit to restore them.
Okay, but hang on. Didn't they have big write-downs last quarter and the quarter before?
You remembered correctly. This is the 3rd straight quarter with multi-million-dollar write-downs.
Right. So is this really proactive positioning, or is it a sign that maybe their assumptions about how much these older engines are worth at the end of their life might be consistently too optimistic? That feels like a recurring issue, not a one-off cleanup.
The market certainly seems to be treating it that way. Like a recurring risk to the value of their assets. Lessors make money leasing, but also on selling the asset at the end if those residual values keep getting written down.
It undermines the whole model, or at least that part of it. Okay, G&A surge, recurring write-downs. Anything else? Finance costs. Rates are high.
Yep, that was the 3rd hit. Net finance costs jumped by $9.3 million, up to $37.1 million for the quarter. Their total debt is now about $2.24 billion.
Oof. $2.25 billion in debt. In this rate environment, what does that do to their margins going forward? Is that sustainable?
It means margin pressure is likely here to stay until rates come down significantly or they pay down a lot of that debt. And part of the increase this quarter, about $6 million, they said, was actually non-cash costs tied to unwinding some old interest rate swaps early and paying down other debt after they raised capital last quarter.
Okay, so some noise in there from refinancing activity.
Right. But the underlying debt level and a higher rate environment are real pressures. So you have this perfect storm hitting the expense side. G&A jumps partly due to maybe ongoing SAF costs and sticky compensation, recurring write-downs, getting asset values, and higher finance costs from more debt and higher rates.
And the big question becomes, are these just a bunch of temporary blips that all hit in Q3? Or are they signs of permanently higher operating friction needed to actually compete and make money in this tight MRO world?
Exactly. That's the core debate the market seems to be having.
Okay, strategically, though, they're not just sitting back. You mentioned they raised capital. Are they putting it to work? Any big moves?
They are definitely active. Post-quarter, their joint venture, WMES, locked down a big new credit facility, $750 million, 5-year revolver. That gives them a lot more firepower.
$750 million. That's serious flexibility. Are they buying assets?
Yeah. During the quarter, they added 16 engines and 6 aircraft, spent about $136 million. That included a deal for 12 engines coming off lease from Air India Express. So portfolio growth continues.
And any interesting hires or strategic shifts?
Yes, actually. They brought in a new SVP, specifically focused on M&A, signaling maybe bigger deals are on the horizon. And importantly, another new SVP focused on aircraft leasing and trading.
Aircraft? I thought they were mainly engines.
They are, but the idea here seems to be to build out their existing aircraft leasing side more strategically. Not to compete head-on with the giant airframe lessors like AerCap, but to use their engine expertise within aircraft leases.
Ah, okay. Like offering an aircraft lease that includes guaranteed engine support through something like their constant thrust program, bundling it all together.
Precisely. Offering a more integrated solution that leverages their core strength in engines and services, making the airframe lease stickier and more valuable to airlines struggling with engine issues.
That makes a lot of strategic sense, actually. Ties right back into those industry tailwinds you mentioned.
It does. And those tailwinds, engine scarcity, MRO jams, the whole Pratt Whitney GTF engine recall mess, those aren't going away quickly. Management expects strong demand and pricing well into 2026, maybe beyond.
And they're positioned for the future engine types too, right?
Yeah, they highlighted that over half, 53% of their portfolio by value is already in the newer tech engines, the LEPs, the GTFs, the GHX engines. So they're not just stuck with old metal.
Okay, so strong operations, solid strategy, major industry tailwinds, which circles us back to that valuation disconnect. You said management even called it out.
It did. They basically said the market cap, around $850 million, just doesn't reflect the business's value. If you look at their book value, the common equity is about $650 million on its own.
Okay.
And then you add the estimated unrecognized value in the lease portfolio that gained potential we talked about from asset sales, which some analysts think could be approaching $600 million.
Wait, so book value plus potential hidden value gets you to over $1.2 billion?
Yeah.
Compared to an $850 million market cap.
That's the math they're hinting at. It's a huge gap. The market is essentially saying either management is way off on that hidden value or those cost issues we discussed, the G&A, write-downs, finance costs, are permanent and can eat away any extra profit from the current boom.
And the stock price action screams the latter, right? Down over 40% year to date, you said, lagging the airline ETFs like GAT significantly.
Severely lagging. JGS is actually up nicely over the past year, while WLFC is down almost 50%. That divergence is really stark.
Okay. That sets up our final segment perfectly. This is not financial advice. Disclaimer up front, folks. But if you were an analyst pitching a bold, maybe slightly outrageous trade based on everything we've just discussed, what would it be?
All right, channeling the hedge fund mindset here. The thesis is basically deep value meets extreme pessimism. The market freaked out about short-term cost noise and completely ignored the multi-year structural tailwinds and the underlying asset value. It feels like an overreaction.
Okay, market overreacted to temporary problem.
Right. So the trade is designed to play the rebound, the mean reversion. It's a pair trade. Go long WLFC and simultaneously short the GG ETF.
Long the beaten down supplier, short the airlines it serves. Interesting. Explain the logic.
JGTs is up maybe 19% in the last year. WLFC is down almost 50%. You're betting that gap closes. Why would it close? Because WLFC management, having explicitly said the stock is cheap, is now under pressure to prove that $1.2 billion plus intrinsic value.
How do they prove it? What's the catalyst?
Two main possibilities, I think. One, those costs start to normalize. The TSAF spending maybe moderates, the legacy comp stuff rolls off, the refinancing noise fades. If G&A and write-downs settle down, the earnings quality improves.
Okay, cost normalization. Makes sense.
The second, and maybe more impactful catalyst, is capital allocation. They have that new $750 million credit line. If they use it for really smart value-adding deals, buying engines cheap, expanding services, or if they get frustrated enough with the stock price and announce a significant share buyback program.
Using their cheap stock to their advantage.
Exactly. Either deploying capital well or buying back shares would force the market to reconsider that huge valuation gap. You're essentially betting against the airline's smooth flight path, represented by JTTs, and betting on the hidden value within their critical engine supplier, WLFC, being unlocked.
Okay, that's definitely an interesting contrarian idea. So wrapping this all up, WLFC is clearly benefiting from the chaos in global aviation record revenues. High utilization prove that.
No doubt about the operational success.
But this quarter really put the spotlight on costs. The rising G&A, those persistent write-downs, higher interest expense. It's spooked investors and raised serious questions about the quality and sustainability of those earnings, leading to that sell-off.
It did. Which leaves us with the big question for you, the listener, to ponder. We know the MRO crunch is likely peaking around 2026. Engine scarcity isn't going anywhere soon. So will WLFC's clear pricing power and underlying asset value eventually win out and overcome these internal cost hurdles?
Or are those higher costs just the unavoidable price of doing business, the cost of staying relevant and capable in this incredibly demanding aviation ecosystem right now?
That's the billion-dollar question, isn't it?
It certainly is. Thanks for joining us for this deep dive. And just a final reminder, this discussion was for informational purposes only. It is definitely not financial advice. Always do your own research and consult with your professional advisors before making any investment decisions.